Welcome to Let's Chat. My name is Jim Parker. I specialize in helping people sell businesses. I'm really excited because today we have with us Monty Walker. Monty specializes in helping people with tax consequences when they go to sell their business. He's a nationally known CPA. He's a great all-around great guy, and he's extremely knowledgeable. We are honored to have him here. I wanted to invite him on because a lot of times business owners are so concerned on how much that they are going to make from the business on the sale, that sales price, which is important. But at the end of the day, it's not just how much you're going to get for that sales price from the business, but how much that you're able to keep in your pocket after you're paying taxes. And I think a lot of times business owners don't think about the tax consequences. And if you're thinking about selling your business, or if you're a business broker out there and you're working with a seller, that's a lot of times what questions are being asked. And that's why I wanted to introduce you to Monty. Monty, thank you so much for joining us today. I really appreciate it.
Absolutely. I'm glad to be here.
Hey, Monty, if you don't mind, could you give a little bit of background, real quick, a little bit of background about yourself? I want the audience to understand your credentials and your expertise in this arena.
Great. I am a CPA. I'm based out of Texas. At any given point, approximately 95% of the work coming out of the firm here is happening around the country. So Texas is a big place, but to only have 5% here at any given point just kind of gives an indication of our national reach. I've been doing private work in advisory services for merger acquisition transactions, which really is a fancy way of saying I do advisory work for people who are buying and selling companies. And it's all closely held. So many transactions that, whether that's a $5 million, $1 million, 500,000, that's all relative to the benefit of the person selling, but I'm open and available to deal with that, and that's what I made myself made myself as a foundation in our practice. As I said, about 30 years ago, and prior to that, I was in industry. I'd worked in several businesses, but specifically, I ran a family office for a wealthy family for a period of time prior to going into private practice.
And I want to say this too, Monty, because most of the business owners out there that are, successful, they have a CPA that they are working with, and a lot of times they've worked with that CPA for many years, and they've got a great relationship with that CPA. I do want to really point out the fact that, most CPAs that might be really good at what they do as far as filing taxes and giving you tax advice, but they do not come across or they don't deal with business sales very often, or they have never dealt with a business sale. So when you're thinking about selling your business, it's a great idea to maybe reach out to Monty Walker or you work with CPAs too, right, Monty?
I do, and I think what you're on track to saying with this is perfect. This local practitioner with a business owner is like the general practitioner who's a physician. And so that you go to your local physician for any medical need until they identify you have a specialty problem. And then if it's heart, they send you to the heart doctor. Well, I'm the heart doctor in our topic today. You keep your general practitioner. I step in and actually work with your general practitioner as needed, but I have the specialty knowledge that heart doctor would be able to provide. And that's my role. That's my lane. I serve that lane and I'm back out of the way.
Monty, I really love that analogy. That's fantastic. I'm going to start using that analogy when I'm explaining you to sellers. I think that's awesome. So why don't we start off talking like in general overview terms about the taxes in a business sale? Can you give us like a brief overview of what kind of taxes a seller might face when they're selling their business?
It's a very broad question, but when selling a company, there will be a gain, hopefully, from the sale of that business. And that
Hopefully.
gain would, hopefully, and that gain would come from any actual assets that somebody has. We're talking equipment, vehicles, but there's also an asset called goodwill, the intangible that gets sold. And when these assets are getting sold, there will be a ordinary gain for ordinary tax treatment, and there will be a capital gain for capital gain tax treatment. And then how that really applies has everything to do with the choice by which a business owner is operating. Are they a sole proprietor? Are they a C corp? Are they an S corp? Are they a partnership? So there will be so many different avenues that those taxes can come out and apply based on ordinary and capital gain treatment. But it's a very complicated area because you can't nail down one answer for that.
Right, right, exactly. You know, that's the one thing about this video. You're not gonna be able to walk away and know what you're gonna have to pay in taxes, but you need to understand kind of what you're gonna be facing. And Monty, maybe you can give a little bit more insight on capital gains and ordinary tax and how that is affected with the sale of a business.
Let's just take an example of somebody who is operating from an S corporation. It's a very common structure. If somebody has equipment in there, and let's say they purchased that equipment for 400,000 and right now it's being sold for 200,000. But the full 400,000 has been depreciated. People buy equipment because they can get a tax write-off. They get the tax practitioners will tell their clients, it's time to buy a piece of equipment. We're going to depreciate that and immediately write the entire balance off. Well, what happens is, under the Internal Revenue Code, when you sell a piece of equipment that has been previously depreciated, any gain on that equipment is taxed as an ordinary gain, not as a capital gain, but as an ordinary gain, because there is a concept called depreciation recapture, which occurs. And that means that somebody has to pay ordinary gain on the prior deduction that was available for the depreciation deduction. And in that same example, maybe somebody is selling for a high enough price that they also get to sell their goodwill. So if goodwill is sold in this S corporation, it would receive capital gain treatment, possibly a 20% tax rate. So ordinary taxes could be as high as 37%, and then capital gain tax treatment could be 20%, possibly as low as 15%. So there's a big difference in those, and certainly is a motivating factor for people to try to get as much as they can to the capital gain category.
Okay, great. And let's take the thing about the furniture, fixtures, and equipment real quick. So they depreciate their equipment. Let's say they're depreciated $400,000 worth of equipment, and they are now selling that, and the allocation of sale for the business on the equipment is going to be $200,000. So they're going to be taxed on the ordinary income of that $200,000, correct? That they're
Correct.
selling the equipment for. Okay.
Correct.
All right. And you know, one thing I want to make clear too, if we could go to this, is sometimes I talk to a business owner and you know they immediately jump to, well, I'm going to be paying 37%. You know, can you explain the step up a little bit on the step up on that? Doesn't immediately drop to that, go to that 37%.
No, our tax system is based on a tiering system. We have brackets. And when somebody is selling their business, it will add total income into their personal tax return based on the example that we're giving here with this S corporation. So S corporations pass through, it gets taxed on somebody's individual return. The total amount of income that they have in their return ultimately determines the level of tax that's being paid. And if somebody has got some portion of their income that's in the 35% bracket, that doesn't mean that they are paying 35% of every dollar as tax. That just means they finally got some of their money in that bracket. Their average could be 28 or
Right.
30. So what happens is a person's effective tax rate derives their total tax, which is an average of how much it's coming out of all those brackets.
Yeah, and you can Google those brackets too and see where those different brackets step up, and you can see, I forget what it is, like $750,000. It's like the $250,000 of income, and anything over 750 is 37%. I mean, don't quote me on this; that could change, and I'm just kind of giving estimates as well. But
Yeah.
you know, that's kind of the scenario, right?
That's correct. You can Google that up. The IRS puts the brackets out every year. It's the exact same bracketing system that everybody faces when they're doing their annual tax returns.
Okay, so real quick, in a nutshell, before we move on, for sale of furniture, fixtures, and equipment is what kind of tax?
Ordinary tax.
Ordinary, and we're looking at around how much?
It could be, depending on the size of the business, as high as 37. Unlikely to be that, but the bracket system goes that high.
Okay, great. And then on the goodwill portion of the business, which is the things you can't touch and feel, we're looking at a capital gains taxes, and we're looking at about 15-20% around that.
That is accurate. 15 to 20%. And one little item that has to be thrown in there that gets missed often, and that is Obamacare. So many years ago, when Obama was in office, we had a new tax come into the system called net investment income tax. That is 3.8%. It's applied to capital gain, and it's applied to capital gain for people who are not operating a business. So if you have two owners in an S corp, one of them is a non-operator, meaning just a capital provider and investor, and the other one operates. The non-operator has to pay an additional tax, 3.8%. So that's one that sneaks up on people.
Okay, great. And so you're looking at a scenario, and I run into this a lot, when I'm talking to a business owner in the early stages. And, obviously you have to put a sense of reasonability on how much the value of the furniture, fixtures, and equipment is. But a lot of times the sellers, right out of the gate, are like, are mentioning values that are very, very high on that furniture, fixtures, and equipment. And it's really actually in their best interest to have the furniture, fixtures, and equipment on the lower end more times than not, right, Monty?
That's accurate. The problem is most people believe that when they're asked how much is it worth, they believe giving a high number is what they are being asked to do. So their response is naturally to talk about as high a value as possible because they believe that's what they're being asked to provide. But the correct answer is it needs to be what is accurate. It needs to be the real market value, and that's often not a high number. It could be much lower. So the lower the number, the better off the tax outcome for a seller.
Okay. All right. Great. Great. All right. Moving on to like tax strategies and trying to minimize, the tax liability. What are some common strategies that business owners can use, or you can use to minimize that tax burden when selling their business?
We've hit on one big one. That's the allocation of purchase price. That's a very big one.
Can we pause right there real quick? Do you mind explaining what the allocation is?
The allocation of purchase price is how much gets placed in each of the categories of the assets that are being sold. So when a person is selling a business, the equipment that we've been talking about would go to the buyer. Computers would go to the buyer. The inventory would go to the buyer. Goodwill would go to a buyer. So all of these categories receive an allocation of what the overall purchase arrangement is. That's called allocation of purchase price.
And it
And
adds
this
up
has
to
to
the
be
total purchase price of the business.
That's correct. And it has to be reported to the IRS. So when dealing with the sale of a company, the allocation in each of those areas, that will be very important. Can any of the purchase price possibly be moved into categories where there may not be any tax assessed? There are certain structures that can allow that to happen. As an example, a C corp gets a different tax structure than an S corp. So if there's an avenue available between them, you would try to find that. And sometimes you can put money into a retirement type structure. You can move money into that. There are tax deductions that could be available based on the structure of the company. So it's a blend of allocation of purchase price and finding ways to be able to get deductions available that can make the taxes come out in a much lower possible, as a much more possible amount.
Yeah, and this is why I think it's important to have the conversations up front on what that tax situation is going to be. I mean, one, if you're a business owner and you're looking, or business owners looking to sell their business, they sometimes don't think about the tax consequences until it gets close to closing or after closing, and they may be shocked. And on the other side of that, it also allows you to kind of strategize up front on how you kind of want that allocation to look. And I want to be careful because it is like when you're coming up with the value of the furniture, fixtures, and equipment, it should be at what the going rate is, the fair market value for that equipment is. But it's not an exact science. It's usually kind of like, this low end to this high end. And, if you shoot out a high number up front, because like you said before, Monty, a seller says, yeah, no, my equipment's worth 750,000 because they're trying to show the buyer, I've got all this equipment, and it's really not worth that much. Well, when we go to negotiate a contract, the buyer's thinking about their tax situations as well, and they're gonna be saying, well, that equipment's worth 750,000, so we kind of have to set that milestone kind of up front.
That's exactly right. And you deal with tax matters early on when thinking about selling. So this is not best done reactively, meaning you don't wait down to the end. You proactively deal with tax, and that means as early on in the planning process as possible.
Absolutely. I think you're absolutely right. How does an installment sale work, and how does that help, spread out the tax liability over 7 years, like an earn out or?
Installment installment sales allow for money to be paid over time. So any transaction where a seller is going to finance part of the transaction, meaning a lender is not doing it, the seller has agreed to get paid over time. Any portion of that arrangement that gets paid after the end of the current tax year that involves the transaction, anything after that is called an installment note. So the installment note allows for income to be recognized as the payment is being received. So instead of recognizing all the income related to that note in the year of the transaction, the money can be moved into the future, and the seller receives payment when the note payments are occurring, and that payment then results in a tax obligation as the payment is received.
Yeah, and Monty, I'm sure from your perspective as a CPA trying to save the seller taxes, that's a great tax strategy, and I'm probably going to get my head cut off by a lot of business brokers for saying this, but I'm not a big fan of the seller notes because of the risk that's involved to the seller post closing because they're losing control of the situation. The buyer now owns the business, and are they going to get paid on that note like they're supposed to get paid? And that's always my concern. So,
I agree. A bird in the hand is the money you can get. The note is an unknown, and that is a problem. So there is a risk factor going forward if you've accepted a note. No,
yeah.
there's no doubt about that.
And there's sometimes I think a note is important, like a seller forgivable note or an earn out in a situation where there's a major client concentration or something like that. I'm not completely anti note. There are times and places for that. It's just not something that I think sellers should do because I'm worried about the risk on the back end.
A seller would not intentionally or should not. My advice to a seller would be to not set up a note unless it's a necessity. So if the option is there to either get paid in cash or get paid in a note and get paid out over 5 years, I will tell a seller every time, get the money today. There is one thing that is a fact. People should not let the tax tail wag the dog. And too many times that tail's wagging with that tax and it's controlling everything. But you should not let that be the case. Sometimes you need to pay some tax
Monty,
for
that's
your risk.
why that's why I really respect you and like you because you really see the whole thing, not just in what you can say, but you're looking at that whole picture and you really care about the people that you're working with and you're looking out for their best interest, not just trying to save them taxes, but the realities of them getting ahead, out of the deal.
Right.
So what about 1031? Explain a little about 1031 exchanges and how that may save on taxes.
A 1031 exchange is a common structure that people have heard about, but they may just have never heard the term. Most people are accustomed to going to a car dealer, taking their current car, and exchanging it. They trade it in. Well, that's called a like kind exchange, and that so everybody understands somewhat the concept here. Now, 1031 though, under current tax law, only applies to real estate. So what somebody would be
Good point.
accustomed to knowing they do when they're personally buying their vehicle, you take that same concept and put it into this area of 1031. And if you own a piece of real estate, you're able to take that piece of real estate and exchange it for another piece of real estate and not pay tax now. It's a way of deferring tax obligations, but yet being able to pick up other real estate. So if you own a warehouse, you could go exchange that for a raw piece of land, ironically, an oil and gas lease if you thought that was a good thing to do, or you can exchange it for another warehouse. But you can exchange real estate for real estate and defer tax obligations by doing so.
And let me ask you, Monty, on that note with the 1031, it's only for real estate. A lot of times business owners are looking to sell their business and they want to sell the real estate because they do have the option that they could sell the business, hold on to the real estate, and charge rent to the new owner, and they have that passive income coming in. But a lot of times sellers don't want to do that because they're getting into retirement and they don't want to have the headaches of dealing with tenants and toilets and trash and all that other stuff. They just want to be let go of all that and not have those headaches. But they can take that, right? If I'm not mistaken, they can take a 1031 exchange and they can do like I don't know if it's called an EFT or what, a system where they're buying into a larger thing where it's a company that owns a lot of real estate around the country, so they're not the direct tenant themselves. You can do something like that, correct?
That's exactly right. So somebody can take a piece of real estate, and if they don't want to hold that real estate, which many people don't, you've just nailed it down. They do not want to be some overseer for another party, have to mess around with dealing with problems with the real estate. They don't want to do that. So are they able to defer the uh, tax obligations by moving it into a 1031 and being able to pick up another property or a load of properties? The answer is yes. So they are able to actually go out and do that.
Yeah,
Yeah.
so that way you're not dealing with the problems of being a tenant, but you get the benefits of the 1031 exchange. Yeah.
That's exactly right. It's all part of the 1031 exchange process. It's that you're picking up an investment out there where you're not overseeing the actual piece of property yourself. So
See, I think
you're able to do that.
I think that's a fantastic situation for a seller. I love that.
It
What
is.
about structuring the deal for tax efficiency? Can we touch a little bit on that and maybe start off by talking a little bit about, how does the structure of a sale, an asset sale versus a stock sale? I think that's probably the first one that comes to mind, and how that impacts the taxes on a seller that they want, how much a seller owes at the time of
But
closing.
when you start looking at transaction structuring and you're contemplating something like a stock transaction versus an asset transaction, then sellers are trained, and especially from their tax advisors, sell the stock. That's just a natural response. And the reason why is stock will typically get capital gain treatment. So lower tax is typically associated with selling stock. On the alternative, buyers prefer to buy assets. The buyers want to buy assets because the buyers get to write off that purchase price. And when a buyer buys stock, that is generally not available to them to write off the purchase price, meaning deduct it, expense it through amortization and depreciation. So sellers want to sell stock because they get the best tax outcome. Buyers want to buy assets because they get the best tax outcome from them. And now we get into tax efficiencies. How can we create blends of both of those that could benefit a buyer and a seller? How can you do a transaction where maybe some of the transaction is for the purchase of assets of some form, and maybe some of the purchase is for the stock? Those are called bifurcated transactions. So you can actually do some of those things given the right fact pattern.
That's really interesting. I actually didn't know that, Monty. That's really interesting. I'm going to see you this weekend at the M&A course source conference. I want to get in a little bit more depth about that.
Yeah,
The seller wants a stock sale, the buyer wants an asset sale, and then there's also a situation where sometimes we have to do. Let me step back real quick. You were talking from a tax perspective that a seller would prefer a stock sale because they're going to save on taxes, and a buyer prefers the asset sale because they can depreciate things quicker. Correct?
that's
there,
right.
there's other reasons that deals kind of happen on an asset sale or a stock sale anyways, and I'm not an attorney, I'm not giving legal advice, but on an asset sale, a buyer's buying a business, they are setting up their own corporation and they're buying the assets and goodwill of the seller's corporation, and at the end of the day the seller's going to have a shell of a corporation. That corporation is not going to own anything. And what buyers tend to like with that asset sale situation is that it's giving them a little bit more protection from a legal standpoint from any known or unknown liabilities that might be out there. And that's why they also like to do an asset sale. It just kind of protects them a little bit. And sometimes we have to do a stock sale because we're in a situation where there's contracts out there. We need those contracts to go to the buyer, and if the buyer sets up their own corporation, and it depends on how those contracts with customers and clients are drawn up, but there might be a situation with in an asset sale that once the buyer sets up their own corporation, those contracts are null and void. So the buyer's best interest is to buy the stock in the corporation. And in that case, when the buyer looks at it and goes, yeah, okay, a stock sale is better from that perspective, we're also in a situation where the buyer's looking and going, well, I'm losing out on the tax benefits that I would have had on the asset sale. And then they could propose something like a 338H10, and maybe just give a little bit of explanation on 338H10, Monty.
Okay. What you're talking about here is the availability of elections under the U.S. tax code. It's a possibility for an stock transaction to actually be treated as an asset transaction for tax purposes. Now, this can be done with both a C Corp and an S Corp, but these elections are predominantly done with S Corps. A little bit more complicated with C Corps and a lot different tax outcome. So, assuming you had an S Corporation, the buyer wanted to purchase the stock of the S Corporation using a 338H10 election, specifically 338H10's Internal Revenue Code. So Internal Revenue Code Section 338H10 or using Internal Revenue Code Section 336E. Those are two elections that are available to treat an actual stock transaction as an asset transaction. Now, what that means
For
is
tax
both buyer,
purposes. For tax
yeah, but
purposes.
both buyer and seller are treating it the same way for tax purposes. So for legal, they're both bound to treat it like a stock transaction, but for tax, they're able to treat it as an asset transaction. And both buyer and seller are being subject to asset transaction requirements when these elections are chosen.
Okay, cool. So we're still sticking on the structure of a sale and how we can save taxes on how the structure is done. I want to step back real quick on this allocation, revisit it for a second. So that allocation of sale, let's say we sell the business for $2 million. The seller is going to be reporting to the IRS the next tax year. Please correct me if I'm wrong, Monty, because I'm not a CPA. I'm not giving financial advice. That's why I have Monty on the phone, and I'm not an attorney, and I'm not giving legal advice. But when a seller sells the business, they say they sell for $2 million. Next tax year, when they go to file their tax return, they're going to report to the IRS, yes, I sold my business for $2 million, and this was how the allocation of sale took place. And they're going to say, let's say $500,000 for furniture, fixtures, and equipment. There was $100,000 of inventory, $100,000 for the non-compete clause because the seller's going to have to sign a non-compete clause. And let's say the remaining, and I forget where I was at on that, I guess $1.3 million would go to goodwill. And the buyer the following tax year is going to say that they bought the business, and they're going to give the breakdown to the IRS what that allocation was made out to. And I don't want to go down this rabbit hole, Monty, but for the most part, almost all the time, they need to match. They're going to cross-reference each other, and they need to match. Could we kind of go through like each one of those categories: inventory, non-compete? We talked about goodwill and furniture, fixtures, and equipment, and which ones are being taxed on capital gains and which ones are being taxed on ordinary income. But maybe you can touch a
Mhm.
little base on the rest of the things that will be an allocation, if you don't mind.
Sure. The both parties, you're correct. When a buyer and seller is reporting an asset transaction and they were reporting the allocation of purchase price related to that asset transaction, it's best that those two parties report the same information. And that, I know I'm going to get in trouble for somebody who's going to hear me say this. The Internal Revenue Code itself does not have an absolute mandate that both of those be the same. So the code itself does not have a legal requirement that they be identical. What happens is the information is being supplied to the Internal Revenue Service, and if there's a difference and there's no justified reason why, then it can present an opportunity for an audit. It will mean that one side is possibly making decisions with the allocation that's not consistent with the agreement, and so it can create a problem. So just everybody to know, it's not a legal requirement, but it better if it's not the same, there better be a very good reason why somebody's deviated from it. Now, when you start looking at the different allocations, there's a classing system. There's 7 classes of allocation that happen with the Internal Revenue Service, and it's in the form that's submitted to them is Form 8594. That particular IRS form is where the numbers are placed, and those numbers better be the same between both, between both buyer and seller, unless there's a justified reason for deviating from that. Now, when you start dealing with this, goodwill is in the very last class. It's what we call the residual outcome. You allocate to every other class first, and there's 6 of them, and then you end up with goodwill. Goodwill is typically capital gain treatment. You had mentioned an allocation to the non-compete. That's actually going to be ordinary tax. That's intangible, like like a goodwill is, but it's ordinary tax. And then if you have real estate that's in the middle of this allocation, real estate could get ordinary treatment. There could be a piece of real estate that also gets what we call a section 1250 unrecaptured 1250 gain, which is a 25% rate specific to real estate. And then when you deal with equipment, it will have typically ordinary. Now, many times businesses are selling and the buyer is getting inventory. If the inventory that's receiving an allocation has been written off previously as cost of goods sold, which some people do that, it gets taxed as ordinary income when it gets sold. And then sometimes receivables, account receivable, are included. Business owners are waiting to get paid by customers, but the buyer wants those receivables. Well, if a seller is on the cash basis of accounting, which happens with a lot of tax practitioners filing tax returns, that receivable will recreate ordinary income for it being on the allocation. But if they're on the accrual method of accounting, it will create zero tax because it's already been taxed previously. Which brings us all together to say there is no one fact pattern that will apply to anybody.
Right.
Everything is going to be different for each transaction.
Yep. And I guess, at this point in our conversation, Monty, I think it's good to point out that, if you're tuning in to get a number like this is how much I'm going to owe in taxes or what percentage I'm going to owe in taxes, you can obviously see that, there's a lot of things that need to be kept in, they're kept in mind. But, and you need, if you're a business owner, if you're a business broker working with a seller, you should be encouraging that seller to go talk to somebody like you or have their CPA talk to you so that they can work through all this. But even though you're going to maybe leave it up to your CPA to talk to you, Monty, or the seller's going to talk to you directly, I think it's important that the seller kind of gets an idea of what they can expect when they're doing it. And so I think this would be a great video for people to share with prospective sellers. So
That's right. I think so.
So you were talking about how that works out with asset sales, with non-compete and the inventory and goodwill, et cetera, et cetera. What does it look like when you're doing a stock sale?
Stock sales typically are easier. When you buy stock on an, since we've been using an S corp as part of our example, if stock is purchased with an S corp and no special election is done, we just referenced 338H10, 336E, assuming nothing like that is being chosen, then what happens is the purchase price for that stock becomes tax basis in the stock. It would be no different than somebody choosing in their investment choices to go buy General Motors stock with your stockbroker. You pay whatever you pay for that stock, that's your investment. And then later when you sell the stock, if you sell it for more or less than you paid for it, then that's a gain or a loss. The same thing is true here. You pay a certain amount of money for the stock of this S Corp. You do not get an immediate tax deduction. And later on, if you sell it for more or less than you paid for it, that creates a gain or a loss in that. So that is unique. That process is not unique specifically to just S corps. It's something that would be applicable if you're buying a C corp. It's also going to have some be applicable based on the structure of maybe a partnership. But whatever you're paying for it, if you're buying the stock, often you can't get a tax deduction.
Okay, great. Monty, maybe we can touch a little bit more about depreciation and recapture, and maybe we can start off and you can maybe just explain a little bit about how depreciation recapture works and why somebody would need it to what they should be aware of, as far as depreciation recapture.
When assets are being bought by an existing business, then those assets can be written off as a tax deduction in the current year against operating income. It's an important thing. If you take a tax deduction for buying equipment, it lowers your operating income. If it lowers your operating income, you lower your tax. If you lower tax, you keep the money in the bank account. So tax practitioners are really motivated to help business owners get tax deductions for buying equipment. But the situation with that is once that deduction is taken, the Internal Revenue Service says, we've given you the opportunity to lower your operating income, So we've given you an opportunity to pay less income taxes from an ordinary tax requirement. So here's the deal, business owner, the IRS says. Later on, if you ever sell that piece of equipment, then the gain that you create on that equipment up to the depreciation that we let you take, that gain, you're going to pay ordinary tax. So if you buy a piece of equipment for 50,000 and you take a tax deduction for 50,000, well, if you sell it for 50, you're going to pay ordinary tax on that 50,000 because you got a 50,000 gain. But if you're lucky enough to sell that same piece of equipment for 75,000, which is not happening every day, but assuming that could happen, you've actually got two taxes. The first 50 is the prior depreciation, that's taxed as ordinary. And then from 50 to the 75,000 amount, that 25, that gets capital gain treatment, more of a 20% tax rate. So depreciation recapture is nothing more than paying back your tax at ordinary tax rates because you were able to receive an ordinary tax deduction when you took the depreciation deduction.
So Monty, I just want to throw this question out there because I'm sure that a business broker or a seller might be thinking in their head. Let me give you an example. Seller has, let's say, the fair market value on the furniture, fixtures, and equipment is $500,000, and they say, well, I want to save a lot on taxes, so I want it to be, 50,000. What's your response to that as a CPA from an IRS standpoint?
If they bought the equipment originally for 50 and now they just are, and your point is they bought it for 500 and now they're saying let's allocate 50 to it for the sale
Let's
price.
say it's worth today 500,000. Today it's worth 500,000, and let's say they depreciated the whole thing. And they own $500,000 equipment completely depreciated, and they want to say, hey, the equipment's only worth 50 grand today to save
Okay.
on taxes.
If the Internal Revenue Code requires that the allocation of purchase price be made based on current market value. So if a piece of equipment absolutely, or a group of equipment items absolutely are 500,000 in value, and it can be shown it is 500,000 in value, it is an aggressive tax posture to put 50 on it. And if the Internal Revenue Service identifies that, they will say there's no economic justification for that, and that they can recharacterize that and put it to 500. So no, if it's 500, the answer should be that's what you should do. That's
Oh,
the 500.
I'm
Now,
glad
if there's
you.
a range, but to go with it, if there's a range where it could be 500 or it could be 300, then the buyer and seller are the most knowledgeable parties, and they would come to a conclusion and negotiate with each other to where that ends up. But if it's absolutely 500 and you got hard proof it is, that should be where it lands.
Right, right. And usually there is that range. And equipment's usually the range, low end and high end, and so you got some room in there to kind of pinpoint it down. But the thing is, I just want to make sure people weren't out there listening and going, well, I want to reduce my taxes, so I'm going to make the value of my equipment on the allocation really, really low. I wanted to make sure that they were aware that you're not allowed to do that. So I appreciate that explanation. Now, Monty, on that same kind of mind thought process, is there any way to minimize or avoid the depreciation recapture, or is that impossible to do on those assets?
Now, the depreciation recapture is only applicable to the assets that are being sold. So if depreciation has been taken on assets that are not a part of the sale, note that there is no depreciation recapture on that. So, but the primary way to lower recapture is associated with the allocation. So whatever assets are being sold, then the allocation is a part of that process. Now, with that being said, recapture is not just related to tangible assets, meaning equipment. It's also related to intangibles such as goodwill. And recapture is also associated with things such as the value of a customer base. So there are techniques available that when a business is bought, if it can clearly be identified the value that's associated with a base of customers, and if there's a possibility that the base of customers could change in the future due to a change out in the services that are being delivered, then there is a possibility under certain revenue rulings that the recapture that possibly would be there on the initial payment for those customers that might be able to be eliminated.
Yeah.
So, are there techniques available for wiping out recapture? And the answer is yes, given the right circumstances.
And I think this is a good time to point out too, Monty, that that's the difference between you and the local CPA that normally just does taxes and doesn't specialize in this industry. Is, the local CPA can sit there and they can know that this should be ordinary income and this should be capital gains tax and this is how much should be paid on this and how much this should be paid on that. It's when you start getting these fine tuning of things and looking at the different ways to do it, that's where your expertise really comes in, correct?
That's the specialty knowledge.
Yeah.
That's what it is. American Institute of CPAs, for all those practitioners, have really pressed hard on its membership to get refined and focus heavy in a particular area of expertise. And many have not chosen to do that, just chosen a more broad base of knowledge. I just happen to be one, and many others like me who've just chosen to get really focused in a particular area of practice.
Yeah, yeah. And I just wanted to point. I think that's great that you did, Monty. The riches are in niches, I guess. No, but that you add a huge value to your clients and to the CPAs that are working with you on behalf of their clients. Because again, you go to local CPA as a seller, and that CPA is getting the taxes done. Again, they're just looking at, oh, this should be ordinary income, this should be capital gains, boom, 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 they're done. Boom, that's it. You're getting in deeper, and by you getting in deeper, I'm sure what you're saving on taxes for that seller a lot of times is a lot more than what your fees are, and you're well worth it. And I really appreciate it what you do for our industry, Monty.
Right.
I really do.
Thank you. Thank
So,
you.
what have you seen are some of the biggest mistakes sellers make when they're selling their business, and how can they avoid them when it comes from a tax perspective? What are the biggest things that you see?
Many business owners fail to take action at the earlier part of the transaction. That's a very big one. They should start thinking through what am I going to do? How am I going to handle the structuring issues that are? How am I even going to sell this thing? And they need to get past the unknown, and that is most every business owner will enter into a transaction having no idea where they're going to land on the backside. And it's not just tax, it's structure. Structure leads to tax, but it's getting the whole game plan down. They get to get a pathway together. Now, sometimes business owners misunderstand where their tax obligations will really be. They are making assumptions about what their tax obligations will be when in fact they're completely wrong because they've read something or they've heard something from somebody else who've sold the business. So you need to get with somebody who understands the outcome and model through where you're really going to land. There's also assumptions that the way the transaction can be done, it misleads people to think about where their tax outlay will be. Their idea is they will sell the stock when in fact it may never be able to happen. And the structure that a business owner could be in, as an example, can impact them. If they are a C Corp, C corporations pay corporate level tax, and then there can be a dividend tax coming out of that corporation. There can be double tax. And in a state that assesses a high level of tax, the overall tax loads can get 60% or more of the entire transaction. There can be mistakes made based on that alone, just not knowing. Now, tax opportunities in these environments, they'll begin to, sometimes these owners will think I need to distribute assets out of the corporation. Real estate, if a piece of real estate is in a corporation and the buyer may not want that piece of real estate, or if the seller anticipates that they don't want to sell the real estate, sometimes they will distribute real estate right out of the entity to try to deal with something that they don't even understand. Unfortunately, when you distribute real estate, it creates a taxable event, even though you have not sold it. So people trying to react on their own, it's like trying to do surgery on yourself when you don't even need surgery, but you think you do, so you start working on yourself. So people just need to get the proper advisors around them, plan through where they're headed, and don't overreact on something that they don't understand.
Yeah, yeah. And I know it's really early in the process and you're not able to work everything out, but I think it's good, before you even list the business for sale, that they talk to somebody like you, so they get a really good idea. And obviously not going to know for sure because we still have to negotiate with a buyer, et cetera, et cetera. But they get a good idea of what that tax situation is going to look like post closing. And then you
Yeah,
definitely want to make sure that before the contract is executed, definitive agreement is executed, that you bring somebody in like Monty as well, because that's where a lot of the taxes can be saved. And you're not just saving the monies up front, from the tax perspective on the day of close, or from how the deal's structured, but you can also help um, business owners post sale, like what they're going to do with that money and investments that they can do, they can save as well, right?
that's right. There's plenty of opportunity that people have. How are they? But some of the decisions made beforehand certainly can affect where they are after the transaction is done. But once somebody has sold, there can be plenty of opportunity for them to make decisions on how to use those monies going forward. But there are plenty of people in their estate planning that once they've sold, they've lost some planning opportunity. So although you can help people after they've sold, the opportunity to make an impact on where they really are at that point is gone.
Right.
So the best impact is to think through on the front side of that. If somebody is philanthropic, meaning they really want to give money away, well, doing that in advance of the sale is a very critical thing to do. If they're charitable oriented, they want to give to charity. There are ways of giving to charity and getting a much better outcome from a tax perspective. If somebody wants to defer income, they don't want to pay tax now. Are there techniques to allow them to defer that income, even collecting the money and still defer? Yes, but once the transaction's over with, they lose that opportunity. So everybody should look to what they need, should be looking at planning on their transaction about where they're going to be once it's over. They should be doing that in advance because
Right. And
after
I
it's a lot.
I phrased that probably wrong. What I meant was, it's not just the taxes of trying to figure out how you can save taxes here and there with the structure, as far as coming down to, finding out recapture depreciation and fine tuning things, but it's the stuff you're going to do post closing with the actual money that you're going to be
Yeah.
able to do. But you need to, most of the time you need to know that up front before before the deal gets closed. So
Yes, and what you've said has a heavy impact on some of the stress levels that some people get into. They get really stressed about the fact that they're going to pay tax. They get so focused on the fact I don't want to pay any tax. And then you find out, well, what is your intention? They want to use all that money to go do something else immediately. Well, if you want to use all the money, you've wiped out a lot of planning options. So now it's more of an education process. Here's what you want to do. Here's what you need to do now to be able to get to what you are about to want to do. And that means sometimes you have to pay some tax. So where people are so get very upside down with themselves about the tax obligations, once you show them why they need to pay some tax to get to that next step, it helps them understand and be okay with it. You can't always get away from paying tax. It's just a part of the planning process.
yeah, yeah, exactly. So I know we touched a lot on S corp and C corp. What about partnerships, or is there anything else you want to add to about C corporations? Because we mainly talked about S corps.
Well, well,
So
Saka, I'll give you a little
partnerships
point
and
on.
C corps.
Yeah, but give a point on C corp. C corporations have a very unique planning opportunity that's available for them. C corporations, the stock can qualify as what's referred to as qualified small business stock. And qualified small business stock, it's very broad. It'd be way too deep to try to get down in these few seconds of discussion. But if somebody's stock that they hold is eligible under the regulations, and specifically it's code section 1202, then there can be up to $10 million of gain per shareholder when selling C corp stock that would be exempted from paying tax, from exempted from income recognition. So it's a possibility that a person can get up to $10 million of gain from the sale of C corp stock that qualifies under this reg and pay no income tax. That's a very amazing thing to do with C corp. So lot of planning opportunities in that environment. And there's also ways of lowering tax even when assets are being sold if it qualifies under this regulation. And with C
Wait,
corps,
can I
there's
pause you right there real quick? I'm pause you right there.
sure.
So if somebody's an S corp, how are they allowed, and how far in advance are they allowed to elect to be a C corp to take advantage of that situation that you're talking about?
Under these regulations, the regulations state that for the majority of the corporate history, the entity would have had to, or the C corp stock would have been C corp related for the majority of its ownership period. So if the same people have been owners and they've owned it for 15 years and it had been an S corp, they are not going to be able to do a conversion and get the benefit of this anytime, meaning to give up S corp stock and turn it back into a C corp if they've owned it as an S corp. You have to be in the
Well, they
ownership
should if they
side of
waited
this.
16
It has,
years.
well, it has to be at least 80% of the time is really when you
Oh,
dig into the
80%.
reg.
Oh,
Yeah, a
80%.
majority of the time, when you look at it, really you have to back into it. There's some tax regulations that help you back
Yeah.
into it. But when you back into it, you identify that approximately 80% of the time, the entity had to be classified as a C corp. And
Got
that means if somebody's been a 15-year S corp, they can't convert it and turn this thing back into a qualifying stock for any. It's going to take a long time to get there. So
So
what that means is somebody has to decide what are they trying to do at the early stages of their operation. Do they want to try to build a company that's hopefully going to benefit as a qualified small business stock, or do they want to get the benefits of being an S corp? But
yeah,
you typically can't get both. You're going to have to
right.
make a decision.
And you know, early in the early stage, somebody's watching this and they're early in their business and they haven't started a business out. You got to remember too, if you elect to be a C corp because you're thinking about selling someday down the road, way down the road. I mean, you're paying double taxation. You're getting double taxed. You know, the corporation's getting taxed and you're getting taxed as an individual. I guess I shouldn't be saying that. You should be saying that. Am I correct? I don't want to get in trouble.
You can be, but in C corps, the only way you're double taxed is to have a dividend. So if somebody thinks that they can work around that, find other ways of getting their money out of there through compensation and those things, they might be able to work around that process. Also, if they have a C corp, they're going to have to reinvest a lot of their dollars for growth instead of distributing. They think they got a 10-year growth pattern in front of them, and they can grow that thing real big, and they believe it could sell and get and benefit from the qualified small business stock. Might be a reason to be that as opposed
Good
to an
point.
S corp.
Good point. Good point. Well, Monty, all up to this point, we've been talking about federal tax for the most part. And how does it play? And I know we don't have much time, but there's 50 states in the country. But how does state income tax come into play in the sale of a business?
The In certain states there are no income taxes whatsoever, right? So those states are fantastic. You can sell your business for the most part and not pay any income tax. Some states actually have an income tax on net income, just like the federal. In that environment, when there's a net income tax, okay, they have to pay tax on the gains coming out of the sale of a business, just like that happens with the federal. There are some states, though, that have a what would be considered more of a margin tax. It's a tax on gross income minus certain tax deductions. It's not on the net outcome. So based on each state, though, the transaction could potentially be creating gains that will be subject to state level tax. And most states, unlike the federal, do not have a difference between capital gain and ordinary. It is just whatever the taxes rates are, they apply, and all the income is added up together. And also, just know this, some states do what we call decouple from the federal system. And that would be if you have a special tax benefit that the federal system offers, the states have to decide, are they going to extend that same benefit to their own taxes, or do they just drop it off? Uh, Not to mention any state, but I'm going to have to. I'd prefer not to. But California is a great example. Everybody knows that there's a lot of taxes in California. But in California, I made reference of this $10 million benefit that you can get for C Corps under Code Section 1202, qualified small business stock. That particular area is an example where California has decoupled. They will tax 100% of the gain, even if the government is taxing none of it. So you get because they decouple. So states can set their own mandate on how taxes are handled, but there will be tax obligations in these transactions applicable to a state just as well as the federal government.
Unless you live in Florida and some other state, you don't have state income tax.
So you got it. Yeah, if you're in a state that has no tax, that's right.
So I got to ask you this question, Monty, because 40% of all business owners in the United States right now, according to Forbes magazine, are born before 1964. So that's right now what 65 years or older, 60 years or older. So we've got a lot of people looking to get ready to retire. And so how can a business owners integrate the sale of the business into their retirement planning to maximize, tax savings?
Now, retirement planning is a pretty broad area. And as a matter of fact, there's a misnomer when somebody says retirement, they're thinking qualified retirement plans. And that means 401k, IRA. And that's absolutely not true. Retirement planning is the use of assets that have been accumulated over somebody's life or maybe monetized through the sale of a company all at one time. So when you're thinking about your living, how you want to spend your time in the future, what kind of cost factors are going to apply. When you think about selling your business, when a business owner is going to do that, that business often is covering a lot of expenses. So somebody's lifestyle about where they're headed, if they look at the assets they've already accumulated, and they also are now going to use some of the assets that are coming out of this transaction for their retirement living, they need to back in and say, how much are we actually having this business pay of what we are going to have to pick up? And that gets lost sometimes. It's very common. There's a lot of expenses being paid by these companies. And so you sell your company, then all of a sudden that has to come out of your own pocket now. So when a business owner is contemplating things such as retirement, look at the IRAs, look at the 401ks, look at what Social Security is going to provide, but look at the amount of immediate income that's going to come out of the sale of one of these businesses and what kind of investments are going to have to be done and what kind of return rates. Should you put money in annuities so you had steady streams of income or not? But very important, get hands around what that business is paying as far as ordinary living type things that people would pay, and make sure you get under control how much it's going to have to come out of your pocket, because businesses are not going to be there to pay for it.
Monty, today we've covered we only got two more questions for you, but today we've covered a very, big topic. It's a huge topic that's very complex, lots and lots of moving parts. It's not something we can cover in an hour. It's not something we can cover in 100 hours. I mean, you've spent your lifetime almost becoming an expert in this. But is there anything that you really think a business owner should know when it comes to selling their business and taxes, that from a broad level that we haven't disclosed today? And maybe I'll wrap the second question in the same question. And is there anything that you think, any one piece of advice that you give a seller
Yeah,
before they sell their business?
yes, it's not practical to contemplate just being able to pay no tax. And don't think that some coming up with some trust structure that you can put your business into will eliminate the requirement for taxes. There are a lot of people out there to prey on your desire to not pay tax. And tax is innovative. Tax and saving tax is done in little small pieces. It's not revolutionary, meaning you're not just going to throw your business into some entity, I trust, and not owe tax. It's going to be the small things that have an effect on you. Some of the things we've talked about today. So do not get brought in on some tax scheme that doesn't make sense. If you don't understand it and it's hard to believe that it could be true, it's probably a problem. So don't let yourself get brought to that. So if I had to say anything, be open-minded about planning, early planning, do what you have to get your hands around the tax implications, but don't fall prey to some promise that makes no sense. There's a lot of people out there willing to prey on you.
Monty, I really appreciate you joining today. I think this is such an important topic, and I do not know anybody that is as knowledgeable as you, that explain. I know it's a complicated topic, and I'm sure that a lot of people are going to watch this video two or three times. but you try to explain things in the most simple way possible for the type of topic that we're talking about. I appreciate everything you do for the M&A business brokerage industry. You're an incredible guy, and I'm proud to work with you, and I'm proud to call you a friend. Thank you so much, Monty.
Once again, I'm glad had an opportunity to be here. Hopefully, this has been able to help a lot of business owners end up in a much better spot when they sell their company.
Well, I'm sure they will. We love you, Monty. Hey, if you're watching this, I would appreciate if you enjoy these videos, help us out. Give us a like, make a comment, subscribe. That will just help us get the more information out there to other business intermediaries, sellers, and buyers in our industry. And I just feel like the more educated everybody is, it's better for all of us. Well, thank you for joining us today, and have a fantastic day.